One of the problems with recruiting for investment banking is not the knowledge or skills you acquire, but the access to talk with real investment bankers to put your best foot forward. Our sponsor, WSO Academy, can provide those connections with 60 head mentors who are finance professionals at top firms like Goldman, Centerview, and JP Morgan. Imagine being able to get on the phone within 24 hours with one of the Academy's 1,300 mentors right before a critical interview. Get on the waitlist for WSO Academy today by clicking the link in the show notes or by visiting wallstreetoasis.com/academy. All right. Welcome to Investment Banking Insights. This is the podcast dedicated to helping you learn both the technical and non-technical aspects of investment banking. My name is Alex Mason. I am your host, a current first-year MBA student at Cornell University. Thrilled to be part of your journey. And I'm just talking about LBOs today. That's what we're doing, talking about leveraged buyouts. And today's question is a very simple one. What is an LBO tax shield? What is a leveraged buyout tax shield? Well, let's come back to this concept of taxes and debt. So when a company takes on debt, there are tax benefits, right? The government typically provides subsidies for borrowing money. And why does it do that? Because it wants to facilitate credit and money flowing through the economy. When money is flowing through the economy is healthy. When money is not flowing through the economy is unhealthy. So there are some tax incentives for doing this. And we can remember this general concept when we think about some of the episodes we did a month or so ago when we were talking about discounted cash flow and from studying the weighted average cost of capital formula. Remember that? Yeah. And remembering within that WACC formula that the cost of debt must be multiplied by 1 minus the tax rate. And the reason we do that is we want to account for the fact that the interest on that debt is tax deductible. So if we just extend this principle to leverage buyouts, it applies here as well. When debt is raised for a leverage buyout transaction, once the deal takes place, the company can start writing off the interest that it pays. That's why it's this quote unquote tax shield. But really, we can't fool ourselves into thinking this is just all a perfect solution, right? Because for every action, there's an equal and opposite reaction. So it's all well and good, but we can't forget that the company's overall cash flow would otherwise be higher if it didn't borrow the debt at all. Because remember, when you borrow money, you have to pay interest expense, and that's going to hit your cash flow statement, and it's going to reduce the company's cash flow. Now, tax deductibility lowers that burden, but it only defrays some of the interest expense. It's still an expense at the end of the day. So just a note on that. But remember, why do firms do this? Why do private equity firms borrow this money? They're doing it so they can generate high rates of return for them and their shareholders. They want to put in a small amount of equity, have the company borrow a large amount of money, and use that capital to improve the value of the business, then sell that business, usually at a higher multiple. You add some growth onto that, and boom, you've got a high return on equity there for your private equity firm. So that's really what an LBO tax shield is. Super short and sweet for you here today. Thank you for listening to Investment Banking Insights. Again, my name is Alex Mason. I'm your host, and I'm so grateful that you're listening today. Thank you, and I hope that you join me next time as we continue to talk about leveraged buyouts. Have a great day.